Oh, gotta go. No, just kidding.
Yeah, it's for quality assurance purposes, is it?
Oh,
Oh, we got a lot of people joining today, which is great. It's a hot
There was a
topic.
lot of
That is
people
good.
there's a lot of people that on the Facebook group said they were coming for sure.
Mm.
Patty's got a full house.
Yeah, I was just
Yeah.
gonna say that. Look at them.
Yep, I got the whole team here. Well, interior
Nice.
team, ready to learn.
Great. Oh, today's a great topic.
Patty, I have a call with you tomorrow, don't I?
Yes, you do. I
Sorry, I
can't.
had to rebook. Us Canadians had a holiday.
I know. I hope everybody enjoyed it.
It was hot.
Cool. It's just it. It's nice.
That's why we're going over this now.
Holy crap, Jordan! I don't think I've ever seen you in an office setting before. This is great.
Yeah.
He's
This
got
is
the
Kent.
haircut.
Everybody hasn't met Kenton. He's one of my partners.
Oh, welcome, Kenton.
Oh,
I went through the calculator today, but there was a lot of unknowns that I have questions about.
good,
So,
good. Yeah, there's a couple of things in there. We'll be working through that in pretty detail today. I know that Adam's pre-populated his, so he was like sort of my beta test user. So we'll run through that. Hopefully, if you're still cool with it, with an example of how you've done it with one of your employees, Adam. Yeah, we'll definitely touch on that today.
You can fly at her, Leeroy. Use all of my information. I have nothing to hide.
So I mean, today we're going to talk about basically calculating your employee charge out rate, and in there you're going to be looking at, there's the PFC way that they've taught you, but a lot of the times when I've heard from the community is it doesn't necessarily work, especially if you have like a service only division. There isn't any materials or subcontractors on those jobs. So what I'm going to show you today is actually going to cover that, and then also it's going to work for salaried billable employees. So if you've got project managers that you consider billable because they're spending times on jobs, this tool is actually going to help you calculate a charge out rate for that as well, which is really exciting. And if you like spreadsheets, you're going to nerd out a little bit about all the things I've done in there. It's pretty cool. So I know Adam was like, I'm going to steal how you're doing certain things in there. So.
Yeah, and then I'm like, Leeroy, your spreadsheet's incomplete. It needs more information. It's just like, shut up. It's good.
It's good. Yeah, it needs to be tested before I share it with you guys. So that was great. We've got Kate on here as well. Awesome. Cool. Just give it another 2 minutes and then we can kick this thing off.
Courtney is our other admin, just so you know. She's here to learn.
Hello.
Oh. Okay, let me turn off everything that can distract me. All right, that goes for everyone else. Make sure your emails are closed or whatever if you want to be, it's only going to be an hour, but I know that sometimes having your emails or phone next to you can be a bit of a distraction. So, all right. Okay, cool. I'm going to kick this off. Let's just make sure I got the slide up. Okay, cool. You guys can see that. Yeah, perfect. All right. Cool. Thanks for joining everyone today. It's nice to see there's quite a packed house today. So again, today we're going to look at calculating your overhead rate as well as your charge out rate for employees. So for any newcomers, a little bit about myself. So I'm one of the co-founders of Check the Level. Effectively, why we started this company was I come from a business of small business owners, a family of small business owners. My parents started 12 businesses when I was a kid. Just meant, a lot of stressful conversations at the dinner table, a lot of concerns about money, cash flow, really struggled with financials. And that ultimately inspired me to lead a career in accounting and business. So I've qualified as a chartered accountant from KPMG. I've done my MBA at the University of Toronto. And then I took all those learnings and started a company called Check the Level, which is focused on helping contractors know their numbers, effectively be more confident in your businesses, right? Cool. So what we're going to cover today is I'm just going to do a little bit of a recap of last month's Q&A, because this topic today actually came up because of our Q&A last month. And there's a couple of definitions in there that I just want to run through again before we dive into what is your overhead rate and how to calculate it. At the end, I'm going to then walk through the overhead calculation tool that I've built for you guys. Then at the end, we'll have a bit of a Q&A session if time allows. Something I just want to point out again, like I always like putting the, your chart of accounts or your P&L up in this agenda. And something to be mindful of if you are using the level chart of accounts, effectively, when you look at gross profit, what that is pointing towards is how much profit your jobs are generating for the business. So it's direct costs as well as any revenue generated from your jobs. And why this is really important is if you set up your reporting correctly in your profit and loss statement, you can quickly tell whether your production is generating enough profit to cover your overhead, which would be these other expenses, right? It's one of the quickest ways you can see whether you're underpricing or where the opportunities of improving your business are, because you can either see like I'm making a good profit, but my overhead's too high, or I'm not making enough profit to cover my overhead, and you can quickly fix that. So that's a very important one way to also ensure that you're making or you're charging out at the correct price, right? Is if you've got good reporting set up. Cool. So just to recap from last month, basically, it's important to understand the different types of cost categories in your business, right? It's fundamental as a business owner to understand costs, because costs drive profits, and you can't obviously create a profitable business unless you understand your costs. And there's two types of costs that you need to keep in mind as you run your business. Effectively, there are break-even cost categories, which are your fixed costs and your variable costs. Basically, those fixed costs don't change with production volume, such as like salaries or rent, whereas your variable costs change with production volume. So the more you produce, the more jobs you do, the more costs you incur in this category. So that would be something like materials. And then you have what I like to call project or job cost categories, which are your overhead and your direct costs, right? And direct costs, another way of saying that is your cost of sales, as I pointed out in the P&L chart of accounts earlier in the agenda section. Again, we're not going to touch on break-even cost categories for this session. Happy to bring that up in another session, but what we're going to focus on today, again, is just do a deeper dive into that overhead cost category and how to leverage that to ensure that you're pricing jobs correctly. Cool. So direct cost definition, just to run through this quickly again, direct costs are job costs that can be easily and conveniently traced to a specific project or job. For example, materials, subcontractors, and field staff wages. Direct costs are often variable costs, meaning they fluctuate with sales or production levels. It's better to look at production levels because, sometimes sales aren't really a true reflection of how production is changing, because you might have changed your pricing, for example. Overhead definition. So overhead costs are costs that cannot be easily assigned to a project or job, if at all. Sometimes you can't assign them to a job. And again, there are two types of overhead costs. There are indirect job costs. So I'll talk a little bit about that in a bit. And then there are other overhead costs, right? So your indirect job costs are costs that are difficult to trace to any specific one job or project, but still need to be incurred to perform the work. So that could be field vehicles, workers' compensation, any sort of insurance. Those are your typical examples of like what indirect job costs are. The other type of overhead costs, so these are ongoing business costs like marketing and general administration expenses, like an office staff member or an admin staff member or something like that. To continue that topic of examples, so I've got a couple of examples of overhead costs here. So obviously marketing's a big one. Another one that people don't realize that's not necessarily on your P&L, but any like down payments on debt. So if you're paying off a loan, or even if you're paying off a vehicle, that is overhead because it's an operational cost. But quite often your accountants won't include that in the P&L. We're the only ones that do that, just so that you can get a truer reflection of your profit. But again, those are non-deductible, and I'll talk a little bit more about that later. Some other common examples is like if you rent an office, that's an overhead item. Vehicles is another one, and then like utilities or cell phone bills like Verizon, if you use them, that's an overhead. What other overhead expenses do you incur in your business? If anyone wants to add to that.
Equipment like skid steer, man lifts, small tools, that kind of stuff.
Yeah, exactly. Perfect.
Insurance.
Yeah.
Vehicle payments.
Yeah. Taxes. That's also another one. Corporate taxes.
I mean, on technicality with overhead too, you can consider your admin team an overhead expense, overhead cost, because they're not related to jobs directly.
Yeah.
Team
Exactly.
events, team training stuff.
Software subscriptions.
Yeah, that's a classic.
Training.
Yeah. Cool. So this is some great examples. So the next thing we're going to move into is what is your overhead rate, right? So now we know what overhead is. It's those costs that are difficult or cannot be traced to a specific job. The next thing we want to do is look at what an overhead rate is. So your overhead rate is a cost allocated to the production of your service, right? So it is an additional cost. It's not like a direct cost, like materials or anything, but it is still a cost required to be incurred by the business to perform the work, even though it might not be directly or easily conveniently traced to it. Effectively, by analyzing how much it costs in overhead to provide your service, you can properly price your jobs to make sure there's enough gross profit to compensate for your overhead, right? That relationship between gross profit and overhead is really fundamental in understanding how your business operates. So again, coming back to that reporting, seeing what your gross profit is relative to your overhead can make sure it can really help you understand whether you're pricing your jobs properly. Any contractor that excels at monitoring their overhead rate can significantly improve your profits, right? Like if you have a deep understanding of your overhead and you're monitoring it routinely, whether that's monthly or quarterly, I always recommend at least monthly, you can see a significant change in your profits because that will inform your pricing as well as also help you understand, like, are you overspending in any certain aspect of the business, right? So when we look at overhead rates, there are two ways to actually calculate your overhead rate, right? So the first one, for those guys that are with PFC, they use this overhead allocation factor. I like to call it your break-even markup. And I'm going to talk a little bit about that today. And then the new one, which I'm going to talk a little bit, we're going to do quite a deep dive into, is calculating your predetermined overhead rate, which in your case, because you're in construction, you want to use billable hours as your denominator in calculating your overhead rate, which again, I'll do a deep dive into that in a bit. So when we look at your overhead factor, so the overhead allocation factor aims at answering the following question, which is for every $1 for every $1 I spend on direct costs, so those are materials, subcontract costs, field staff wages in my business, on average, how much do I spend on overhead? Right? And if you had to convert this into a formula, basically what it's saying is, okay, what is my overhead costs divided by my cost of sales? Now be very mindful, it is cost of sales, not sales here. I've seen quite often people put overhead costs divided by sales. That's going to understate your overhead allocation percentage, because your sales is always, well, hopefully always higher than your cost of sales. So if you look at that formula, basically it's saying, okay, for every $1 of cost of sales, which are my direct costs, how much am I spending on overhead? So then you would take that number and multiply it against your total cost of the job to get, okay, hey, this is how much I should be allocating to this job to make sure that I'm covering at least overhead, which in this case would be your break-even markup. Cool. So some things to be mindful of if you do use this method to allocate overhead to your jobs. The first thing is, it's one of the easiest ways to look at allocating overhead, especially if your your reporting set up correctly. Like I pointed out earlier, if you've got your all your true cost of sales grouped as, or all your direct costs grouped as cost of sales, you can just take that cost of sales number and you can take the expenses number, which is your overhead. And if you divide the expenses by the cost of sales, you can get that number fairly quickly, right? Like it can take you a couple of seconds just to figure it out. The other common error I see contractors struggle with this concept is, because you are, like, for example, if we said our break-even markup was 40%, then you're taking that 40% and you're multiplying it against materials. Quite often contractors are like, oh, what I've heard is like, I can't tell a homeowner that I'm increasing the cost of my materials by 40%. They'll just turn around and say, hey, like, I will just go buy the materials myself. That's quite a common objection. But you've got to, in this case, what's ending up happening is you're just allocating overhead to materials. You're not marking it up and taking that as like the price that you'd pick up at the store. If the homeowner is upset that you're allocating 40% on that markup, all you need to do is then take whatever that additional price that you're charging on top of the materials is and just allocate it to labor or subcontractor costs, right? Because again, you're spreading the cost of that overhead across all your direct costs. It's not that you are marking things up as like, this is the official price. It's no, hey, I have overhead and I need to spread that over this cost, over this job. In this case, I'm using material to do so. I just want to take a pause there. Does that make sense? It's very important to have that mindset, right? Like it's a mindset thing here.
Have an example of a number.
Yeah, I mean, I can. I used to have this thing that I built for PFC. Let me see if I can pull it up.
This actually happened in my business. Like we'd had a big job that was labor only, but we didn't put enough overhead allocation to it because that was based on including material in the amount, a certain percentage. So
yeah,
the big difference.
Cool. I'm not sure if this has an official example in here, but like, if you said your current overhead factor is 26% and what ends up happening, this is just a screenshot of the PFC tool, the old one. What you're doing is you're taking your total costs and you're multiplying this percentage against the 46K. So in here, you can actually see the formula. And what a lot of people, if you look at this direct costs, what's effectively happening is you're taking your material costs and multiplying it by a factor of 26%. Now, if you show that to a homeowner, they might be like, sorry, like that doesn't make sense to me. Like, why are you doing that? You're marking up materials at a higher price than what I can get at the store, but it's not that. You're not doing that. You're taking overhead and you're just spreading it across all these overhead costs evenly. I mean, not overhead costs, the direct costs evenly, right? Does that help, Athena?
Yes. Can I get a copy of this?
Yeah, sure. I will add this to this thing over here. So yeah, I'll make sure that I actually share that with you. That's fine. Cool. Coming back to this. So as Jordan just pointed out, the thing that you have to be mindful of with this method is if you have any pure in-house like service department that doesn't have materials when you do jobs, or it's very immaterial the amount of materials that are in a job, this method does not work. You can quite significantly understate your overhead in this case. So if you do have a pure service division, what you want to do is use your predetermined overhead rate. And what that looks like effectively is you want to take your entire overhead cost for your business and then divide that by your billable hours in your business to come out with that rate, because your billable hours at the end of the day is your primary revenue generating activity, right? Like for every hour your guys are working or you are working, anything that's considered billable, that drives your business, right? It's the primary activity in your business that generates revenue. So like if you were a manufacturer, sometimes what you would see is they would have two overhead rates. They could use machine hours as well as labor hours. It really depends on what you consider the primary revenue generating activity in your business. And in your case, as a construction business, it's always labor hours. So when we look at that, effectively your predetermined overhead rate, which I'm going to call your POR, P-O-R, is your overhead costs divided by the total billable hours for all your employees, right? All your active employees. Cool. So let's dive into what we need to be mindful of in this method. So some of the things that you need to be mindful of is if it's done right, this method is more accurate than the overhead factor method.
What
Again,
all am I buying here?
It's
Just one?
it's no for me because I use one of my gift cards.
I'll just mute Colin there. Cool. So something else you have to be mindful of is it requires that you calculate the billable hours for each of your employees, right? I'm going to show you how that's done a little bit later. And the other thing that you need to be mindful of is that if there's any change in your employees' work hours, so whether that's they've been terminated or if you've hired a new employee or you've changed their hours, you need to update this predetermined overhead rate every time, right? Which can be quite tedious, especially if you've got a high turnover of employees. And then again, just pointing out, if you've got like a pure in-house service division, this is really helpful. This is also really good if you are a GC that subs everything out and then use your project managers as billable hours. I'm going to touch on that a little bit later. This is also a great method for that. So once you calculate your POR, your predetermined overhead rate, what you want to do to actually calculate your employee charge out rate is you want to look at your gross wages, whatever you pay them an hour. You want to multiply that by that labor burden percentage, which we covered in last month's Q&A. Then you want to add your predetermined overhead rate to that, and then add your profit rate, like what your target profit for the year is. And I'm going to show you what that is in a moment too. So, cool. So let's dive into getting this form. So I will share this link like before. Just add your email address, and you'll get a copy of this. But I'm just going to show you what this looks like from start to finish. So let me just pull this up. So Adam's actually done this for us, which is great. So when you come to this document, I've come up with a whole bunch of instructions on how to get started. Basically, what you'll want to do is you'll want to create a copy of this document. I share it in view only, but you need to download, like create a copy of it to use it yourself, right? And to do that, you just click that file and you say make a copy. So when I share this with you guys, you'll want to just make sure that you click make a copy. Since labor burden is involved, I've also included this labor burden calculator, which we did last month. So you can quite easily, if you have prepared it, just bring that information over to this document. Create a copy for each employee. Just create a copy of this. And then like you can see how Adam's done, he's got a copy for each of his employees. And then basically, when we look at step one, it's going to ask you to input all your employee information and your targets, and we'll run through this in a bit. And then at step 3 is it just looks at your overhead rate as well as your profit rate. So I'm going to work through this slowly, going through each step. So effectively, when we look at step 1, the first thing that I ask you guys to give us is your estimated sales for the year, right? So you need to sit down and think, okay, how much revenue do I expect my business to make in the next 12 months? I know that can be a hard question to answer sometimes. So I've got a little tip here that says, okay, well, if it's difficult to forecast what 12 months is going to look like, is it easier for you to forecast 3 months, 2 months, you know, and if you can forecast that, then just say, okay, 2 times 6 or 3 times 4, just to annualize that number, right? The next thing you want to do is come out with like a net profit percentage. So how much of this revenue that you've generated or expect to generate in the business, how much do you expect to keep as net profit at the end of the year or that 12-month period? I always like to aim for at least 15%. You know, if you are unsure, that just gives you some wiggle room. You can go all the way up to 20, 25. But again, as you increase this percent, what you'll see is your charge out rate starts to increase. So this is also another area that you can actually tweak a little bit if you're concerned that whatever charge out rate that comes out is too high. Cool. So the next thing I ask you to do is actually input all your employees' information. So you need to put your entire team down on this. And you just put them in the yellow cells. So effectively what happens is you put their first name, their last name, their hire date, their termination date, what department they're in. So I've got a couple of options here: project manager, owner, office, field production. Don't do this for 1099 employees. Again, 1099s don't get benefits. So they're not technically employees. There is no labor burden on them. So you wouldn't have to include 1099s in there.
Hey, Leeroy, real quick, you'll see the termination date is set for 2030, because if you leave it blank, it doesn't activate the terminated field.
Yeah.
So like so you have to put it as like a later date. Obviously, I'm not firing my team by 2030. That's not happening.
Okay, cool. You're not selling
exists.
the business by then and, you know, gonna go buy
Yeah.
that. Cool. Yeah, just be mindful though, this formula looks at today's date. And if your termination date is before today's date, then it's considered terminated, and that has an impact on the formulas that drive. So if it's blank, it's fine. It doesn't need, like, it still works if this is blank, right? Everything works if it's still blank. And just be mindful of that, because that will have an impact. Because again, like I said, when you calculate your predetermined overhead rate, you're looking at any changes in your employees' work hours. So if someone's terminated, they aren't counted for as part of your total billable hours. So the gray stuff is formula driven. So you know, don't make any edits to that. And then I also give some important notes like these numbers are only updated if you've completed step 3. So once you've set the pay type, you want to put the pay rate in. This gets automatically populated based on whether they're a salaried employee or paid hourly. If you have an overhead rate, you can put that there. It's also helpful to know, like, if you are accruing vacation for these employees, are you paying it out with each paycheck or are you accruing it? And then the real important part is step 2. This section over here. So effectively, you need for every employee, you need to say whether step 2 is complete. So we'll take a look at that in a bit. And you only need to do step 2 for billable employees. So office employees, you don't need to do it for, you know, again, subcontractors, you don't need to do those for. It's any employee that when you create your estimate, so if you hover on here, what's the definition of a billable employee? A billable employee are employees whose hours you include in estimates, right? So if you go, hey, I'm going to put this amount, this employee is going to work X hours on this job based on my estimate, that's considered a billable employee. And that means you need to create a labor burden sheet for them. Cool. So this section you can only update after you've completed step 2. So if we look at someone like Erin, who's paid hourly, basically you would complete each of these cells. I've even set it up so that there's like a drop down menu now. So you can just select the employee that you're working on. It pulls in all the information that you need. You fill out the yellow cells. Again, when you fill out the yellow cells, this percentage-based employer contributions, this is region specific. So if you're in the US, that's typically about like your FICA, I think it's for FICA, is like 7.65% is what you want to see in here. Again, if you don't know how to input this information, either speak to your payroll tax accountant and look at your latest pay slip. I have also given you an opportunity. If you need additional help, you can book a 1-hour call with one of our accounting specialists. And depending on what kind of service you already have with Level, it can either be free of charge, 50% discount, or you can get a 15% discount. So there is support here if you need, but I would recommend like your first place of action would be Google's your best friend. You can look at pay slips of your employees. You can even go into the Facebook community and post a question in there, and someone might be able to help you. So there is extra support in helping you complete this if you need it, right? And that doesn't only specifically point to like the labor burden calculator. You'll see a little later, we're going to look at overhead in a bit. So once you've completed this for each of your employees, billable employees, what you want to do is you just want to highlight this section, copy it, and then just paste it next to that employee's name. So here, Aaron, you would just paste it from here and all that information would automatically populate. You can even do it for salaried employees. So here's a salaried employee, which is really cool. Right, so we go as far as figuring out, like, if you want to come out with like a charge out rate for your employee, for your salaried employee, typically here, just with labor burden, this employee would cost you $60 an hour as a fixed employee or a salaried employee on a job, right? And we're going to talk a little bit about like how do we add the overhead to that. So this does work with salaried employees as well. Just wanted to point that out. Cool. So once you've completed the labor burden for each of your individual employees and you've added them to, sorry, this is step 1 to this table. So you've added that additional information to this table. The next thing you'll want to do is complete step 3, which is going to look at your profit rate as well as your overhead rate. Now, something that's really important in the spreadsheet is when you look at each of these employees or labor burden calculations, one of the things that we calculate is the total billable normal hours in a year for this employee, right? So here you can actually see, like, based on this labor burden, we've looked at how many hours are actually billable for this employee. I've also added the overtime section as well. So that is accounted for if you do pay your guys overtime. And then what the spreadsheet does is it looks at all your active employees and then adds the billable hours. So there's 1096, and you can actually see the 1096 over here. And to calculate your profit rate, all you're doing is you're taking your estimated profit, which is $165,000, and dividing it by your total billable hours to give you $15, right? So for every hour that my team member works, I need to add a $15 to that to ensure that I'm actually getting my target net profit over the year, right? And you can actually see that come through in this section. Now, the next one is your overhead rate, right? So again, when we look at that formula on calculating your predetermined overhead rate, you need to look at, like, what is your total overhead divided by your billable hours. So we have your billable hours. The next thing you want to look at is your overhead. Now, if you are if you're using Level's chart of accounts, I've based this on that. So, you can quite easily bring that information over here. You want to look at it on a monthly basis, and then it gets annualized. But the important thing we also want to be mindful of here is when you calculate the labor burden for each of your employees, you are including overhead already, right? So there are components to overhead already being accounted for in the labor burden. So we don't want to double account for that. So what we want to do is we want to say, okay, in this column, what percentage of this cost was actually included in labor burden, right? So as you can see, all the workers' compensation was included in labor burden. So you'd put 100% down here, which means when we look at your overhead, we're excluding that from it because we've already accounted for it. Just going to take a little pause there and see if that makes sense. Because I know that's something that you guys struggle with quite a bit in some of those sheets is like, I'm already accounted for this here. Should I be like, at least, so like this is accounting. If you have accounted for the labor burden, it's already taken care of by just adding like what percentage you estimate was accounted for there.
Leeroy, can I ask a question quickly?
Yeah, shoot.
Just if you have subcontractors that don't have their own workers' compensation, would you just have to kind of guess at how much work you're giving them and then just reduce that percentage on there? Does that make sense, or is there a better way to do that?
Yeah. So yeah, that you're spot on there. Like if you are paying your subcontractors workers' comp, it really depends.
We should not factor it as part of the percentage. So 100% of your in-house workers' comp you're covering, and then you're going to add, the percentage is probably going to go higher than 100%.
Why would it go higher than 100%?
Because 100% of your in-house team would be covering, and then on top of that, your sub trade would also be being covered.
Yeah, I would. Yeah, you could create a separate line here. So one thing you could do is just put a separate line in here and just say subcontractors insurance, and then have that as a separate line item. But if it's already,
could you factor your estimates if you're using I mean, it's better to just make sure they have their own workers' comp.
Yeah.
But
Yeah, Jordan.
we have covered some of ours in the past. Yeah.
Yeah, and it just depends where you're accounting for it, right? So like if that workers' comp is part of overhead, then it's part of your overhead rate, which means you don't need to have like a separate line item in your estimate for that. But if you are already accounting for it in your estimate, then it wouldn't be considered overhead. It would be a direct cost that you're incurring, right?
Right. Yeah, that makes sense.
Because again, like if there's any, like if you're getting very specific about a cost in your estimate, that is typically a direct cost. Whereas like these rates that we're coming up with, these are estimates, so they're effectively overhead estimates, right? The other thing here with payroll expenses, so what you'll want to do is you'll want to exclude billable employees. So if you've created a labor burden sheet for the employee, that expense has already been accounted for, right? Because you're going to be charging them out on those jobs. So you wouldn't include them as part of overhead. So as you can see, we've only got office staff wages here and any sort of benefits, but only 50% of the benefits have been applied because we've already accounted for the other 50% in the labor burden sheets. Education and training, those are pretty straightforward. Any marketing, whatever budget you have, monthly budget you have here, any professional fees, so your accounting fees or legal fees, consulting fees, G&A, software subscriptions, right? Any donations or any uniforms for the office. Bad debts, again, a big one is those payment processing fees. So if you are using like a third-party payment service provider, just make sure that, you're accounting for that as well. Your non-deductible. So what non-deductibles means is these are expenses that aren't tax deductible, but you still want to include in your overhead allocation because it's operating expenses. So typically what we'll see here, your loan payments, your capital lease payments, any penalties or fines that you're expecting to incur, like speed tickets or whatever, owner's draws. So if you don't pay yourself a salary, but you pay yourself an owner's draw, you would want to add that here. Cool. And so once that's completed, basically we take this number, this 363, and then we divide that by your total billable hours over the next 12 months. And as you can see, here's the overhead rates. So for every hour that one of E2's employees works, you need to add $33 to that to cover the cost of overhead. So when we come into step one, that information is getting pulled in here, and you can actually see what those charge out rates should be with employees, right? So, and here's that fixed employee. So this project manager, you need to be charging at least, let's just say $110 an hour for every hour they work on a job to ensure that they are going to meet the net profit target you have at year end, as well as cover, well, it just really does come down to that net profit target, because that will make sure that you're covering your overhead as well as the direct cost associated with that employee. Now, one of the questions Adam did bring up was, okay, like what happens if you're a time and material contractor or cost plus? So you charge based on cost plus, or you charge fixed. How do you navigate this, right? Especially if there's material involved. So what you'll want to do in that situation is these charge out rates account for all the overhead. You've accounted for overhead, right? So there's no need to put that overhead on materials or subcontractor costs. So what you want to do then is what you need to allocate to the material costs and the subcontractor costs is your net profit portion, right? So all you need to do is, I'll actually add it because this is your net margin. So let me just do one thing. So your markup would be, let me just put it here. I'll add this to the spreadsheet. It's this divided by 1. This, right? This would give you your net markup, which I think is about 20%. So yeah. So effectively, if you are using like if you're a fixed price contractor and you want to mark up, even if you're a time and material or cost plus contractor, what you'll want to do is you'll want to just mark up your material costs and subcontractor costs by 18%, right? And then your overhead's going to be accounted for through labor hours. So you can see what we've done is we've taken all the overhead in your business and said, hey, we're going to just apply it to labor hours or billable employee hours. And then the other side of the costs associated with running the job, like material and subcontractor costs, we're just going to mark up by whatever we're hoping to hit from a net profit perspective.
Leeroy,
yeah,
can I ask a question? So
sure.
like I'm thinking like even like a car dealership. So if you have a dealership and they're paying their employees X, they just show an hourly rate.
Yeah.
Right. They don't. So that's the issue that I have with some of my clients. It's like, well, I don't want to pay the extra. I'll buy the materials then. Right. So
yeah.
you, like you say, that needs to get built in. I think that's just better shown in your hourly rate.
Yeah. So and this is what we've done, right? So like, for example, if I go to a homeowner and say, hey, like you're going to be paying $120 an hour to use my project manager, and then the materials and the subcontractor costs, I'm going to mark up by 18% because I have to go collect the materials. I get discounts through the suppliers. There's warranties associated with this. Like the homeowner is it's going to be a lot easier to negotiate with the homeowner in that conversation than saying, hey, I'm actually marking up materials by 40% because that covers up my overhead. So like, that's why I like this method a little bit. I mean, Adam, you had some really good points on that topic, like about objections from homeowners.
Yeah, so like we spread our hourly overhead and construction related materials kind of together. So I don't charge or tell the guys that I'm charging out like my carpenter at $97 an hour. And then I have all my finished materials. So materials generally that a homeowner can go purchase their own. They're not going to go purchase 2x4 screws, glue, none of that. That's not what they're going to purchase. But if they want to purchase like plumbing fixtures or anything else like that, then we charge an admin fee to do the ordering, and we charge a delivery fee, which we have to do also and add the taxes. And we could then display them at cost. So even if the client wants to go purchase them, they can, but they have to deal with all the warranty issues. They have to deal with any damage. They have to deal with all of that. If we do it, then we have the costs involved in that, and it becomes an extra 15% for me, rather than saying I have to mark up a $300 faucet, 60% to cover all my overhead costs. So it's a way for the client to be shown that they have the ability to save money, and at the same time, all of the overhead and profit costs in my construction area is involved there. Does that make sense, Jamie?
Yes, it does. Sorry, I muted myself out. Yeah, for sure.
Cool. Any other questions on this? Again, I this can be very overwhelming because there's a lot of moving parts here. So we are here to support you in this case, but like it's really important that you do this exercise at least once, just to, because if you do it properly, this is going to be mind-blowing. Like what you'll actually find your true charge out rate for an employee is really helpful knowledge. And again, this as I pointed out, this method is a lot more accurate because you're not, the challenge I have with the other method is, you know, it's assuming that every job effectively uses the same amount of material and subcontractor costs in proportion to whatever your labor is. And that's a very big assumption, right? So again, like this makes it a lot more accurate. You can be a lot more confident in your numbers if you take this approach. Again, and we're here to support you if you need help with that.
You can also use this tool in employee wage reviews. So if somebody's, requesting an increase, or you're going to give them an increase, you literally can just put the increase into the sheet. And now you can either, if you're planning on giving them a wage increase, months out, you can then increase their number here and start adding that to your estimates now to prepare for the increase for later.
Yeah.
Rather than guessing.
How much is it affected if you lose, like say you were to lose 3 employees suddenly, and you had estimates out already? Is that going to make a huge difference with this, or like would it be the same as using the other method anyways? So no matter what, you're going to have a challenge with that.
Yeah. So like, for example, let's just say, we're going to terminate a few employees here and see what ends up happening.
Leeroy, would it be what we were talking about the other day, rather than using direct numbers from a certain employee on an estimate, we were talking about using the median percentage or the median number of the section of people that you're using, so that even if that specific team member wasn't involved in the project down the line, you're still allocating the right amount for the labor. In that sense.
Yeah.
It still affect if you lost, because it's determined partly by your head count, right?
Yeah. So like if your head count drops, your billable hours drop, and if if everything stays the same, all your charge out rates increase.
Yeah.
So again, like if your charge out rate goes too high based on your head count, it's really not like, what I'm trying to get to here is there's a relationship between head count and overhead, right? If you have high overhead and a low head count, like you're probably overspending on overhead. There's Chris puts his hand up, right? So this is pretty new. So one thing that I would love to actually figure out is like, especially if you do this quite often, you can almost get a sense of whether you're under or overstaffed based on what your overhead rate is. So if you monitor that, you can quickly see like, hey, like, do I have capacity to hire on another employee, or do I have to get rid of some of my overhead?
Another question, what would you do with like, say, summer, like student employees that are only going to work for 2 months? They wouldn't be tough to factor them in. Do you have that?
So when you do that, basically, because the starting point is you go, oh, hey, how many normal working hours are there in a year? And one of the questions I've asked that I've added here is estimated number of unpaid weekdays in a year. So if you think like, hey, they're only going to be employed for half the year, for half the year, you would just put in whatever, like how many work days are there in a year? There's 52 times 5. You would just divide that number by 2. It's roughly around 125. So you would say, this person is not working for me for 125 days of the year. And that's how you could factor it in.
I guess a big negligible working like 2 months, that's not going to affect the numbers too much because their billable hours would be so small.
Yeah.
Okay.
Cool. Any other questions? You're throwing me some tough ones there, Jordan. Making sure everything I got cross my T's and dot my I's.
Where did you get the billable hours per year, the total?
Over here, this?
Yeah.
So what it does is it's the starting point is to say, hey, there are 2,080 normal hours in a year, right?
Mm-hmm.
Then you go
8-hour days, yeah.
Yeah. Then you go, okay, well, hey, of the,
okay, I got what you're saying. I see it now.
One thing to be mindful of here is to add the paid like stat holidays. The non-billable time effectively is, time that I'm paying my employees, but they're not working on a job site.
Yeah, like
Yeah,
well,
so here in this one, I've added the Canadian stat holidays, BC sick days. I've also added a section where I'm like how many staff meeting hours per month, estimated training hours per month, and then estimated shop cleanup per month. If you actually go to Dean, he has the most amount of essentially non-billable activities per year.
Yeah, and you can see there's quite a big.
Like 64, essentially 64 days of non-billable time for one team member, just
Yeah.
based on because of his role. So it's and as long as you account for that, then when there are down days, you're stressing a lot less.
You can see this. You're estimating that you're spending about $12,000 on non-billable stuff.
Correct.
Yeah.
this is your
Do I-
actuals. This
is
is
my
your actuals,
actual.
Adam?
Yeah, that's my actual.
I'll give you a call later. If
Sounds
that's
good.
okay.
Sure.
Thanks.
Any other questions with the spreadsheet? Other than how do I get it? I'll send you a link shortly. I'll actually put. Hey.
Yeah, I was saying, once we have this and we play around with it, it's only as good as the correct information if I'm putting it in the right place, the right numbers.
Yeah.
Is there somebody that can either help or walk me through at least doing one of them to make sure I'm doing it correctly before I do the rest of them?
Yeah, you're a CFO client, so you've signed up for CFO services. You can, feel free to book in with Jana or another level with it. Yeah, Jana's your primary point of contact, so Jana can help you with this. The big thing we just want to make sure is, because you started with us this month, which is great. We'll just want to make sure that your numbers are up to date before we sort of do a much bigger deep dive into this. But you can take a stab at it, and then book a call with Jana or during your health check meeting, run through it with us, and then we're happy to help you with that. Yeah.
Generally speaking, what I've been doing, just because I stumbled across you guys and I'm just kind of guesstimating, I just found an online calculator. So we'll break down all of our hours, what our materials, etc. I want let's say my overhead's 25% and I'm asking for a 10 to 11% profit. I put that in the margin and it spits out a number, and that's what I've been going with. I don't even know if it's right, if it's wrong.
Yeah.
I don't know. That's why I really want to get this stuff
dialed in.
pinpoint.
Yeah. The biggest stuff that you'll need to review, right, is because you make these are all estimates. You're making assumptions, and the biggest assumption you're making is around like what you expect your overhead to be in a business, and that changes all the time, right? Like from one month to the next, or like inflation's going up, so all our costs are going up. That's why it's important that you need to build in a habit to review this once a month. It's so important in your business that you need a system that goes, hey, this is what I've estimated, these are my actuals, and then based on what the variances are, I'll update my budgets, and then that will have an impact on my pricing, right? I always say in my sales call, like, really well-run construction businesses price based on what they expect their overhead to be in the future, not what it was historically, right? Because that means you're not playing catch up. So again, like once we get the ball rolling with you, Athena, like you're going to have this report, you'll have that check-in with us every month. So we'll make sure that we hold you accountable in staying on top of this.
Thank you.
In this case, I used 6 months of actual data. So I pulled my numbers from January to June.
Yeah. And as you can see, like it's once you're set up in our system and you've got good timely information coming through the P&L, updating this becomes so easy.
I think I did like 10 employees in under 2 hours, and that's because I've been with Level for a year. So all my management accounts are rock solid. So
yeah.
Those that are just starting out, it gets a lot easier once you're in the system. So
Yeah, I love it.
Yeah, it gets to the point where your health checks become just conversations rather than problems.
Yeah.
Finding
Yeah,
things to talk about has been my hey, what's wrong? I don't know.
Yeah.
I hope that's a problem I have soon.
Cool. Any other questions? So I'll send I'll put a link in the chat as to this form.
Do you have somewhere posted the last Zoom meeting
Yeah.
for the burden calculator?
Yeah, so let me just check that out. So let me just go. So there's a couple of places you can find that information. So if you come into the Facebook group, are you into the job costing and bookkeeping Facebook group? I think you're a member here, Jamie.
Yeah, I am. Yeah.
So if you come into this,
everything's in there.
yeah, in the shared resources, I have like a directory here. So if you click on this, it'll actually tell you like here's a resource directory as well as here's like the first Thursdays. I think the recording's up here.
Okay.
So the labor burden ones here.
Yeah, cool. Okay.
And if it's not, so I do set it up. So if you open up the slide, so I do share these slides, and you come to right at the bottom, my internet's being a little slow. You can find a link to the recording here in the actual thing. So
okay, right on. Thank you.
cool. No worries. No, if you pull out that form, you'll get emailed a. Ooh, I put the labor burden calculator form in there. Sorry. Please ignore that form. This is the correct form. Yeah, it flies by. There's a lot covered. Cool. Anything else? All right. I think my cat wants my attention.
Unacceptable, Leroy.
Yeah. Thank you for bearing with him if you heard him. But yeah.
Leroy, do you want me to drop a booking link for me in the chat if people want to book in for 30-minute chat about level at some point?
Yeah, that would be helpful. I can also include it in the spreadsheet itself.
I think Patty's booked in with me already, and Jamie's going to book in with me too.
Yeah. Cool. All right. Sweet. With that, I'm gonna let everyone go. Yeah, just curious for the next Q&A. Are there any topics that you guys would like to cover? Anything come to mind? I mean, you don't have to answer that now. I can come later to it.
Be cool to look at like tips for shape or something like that.
Okay.
You could look at, especially if people are interested in bumping up their level services to find room to pay for that. Would be awesome, just so that you can. I think that's possible. Everybody could share some tips for doing that. Just looking at overhead where things could be cut.
Yeah, I know a lot of you guys have been working on like cash flow forecasts. Like, hey, like when does my bank account go to zero? And how? I know that's a quite a hot topic. I can also think about that. There's quite a lot of moving parts to it because that also ties into managing overhead, right? Cool.
Yeah, I think forecasting tool would be really good.
Yeah, that'd be nice. I'll give some thought to that. That one might take a few months, like a month or two to build, because there's quite a lot of thought I need to put into
Add
that.
it to your growing list, Leroy.
Hey, you guys tell me what you want, and I'll do my best to help. That's all I'm here, right? Like I know numbers. You guys didn't get trained at school in this. It's especially this predetermined overhead rate stuff. Like they only teach you that in university if you're going to do a management accounting course. So I'm here to help you with that, right? And I know Rick's on here. He's great with the mental health side of stuff and staying positive. So do feel free to, knock on his door as well, because he's also quite active on this group.
I always tell people everybody's got their own skill sets, right? So if you think you're not good at one thing, you're good at something else.
Right.
Leroy fills my need for spreadsheets. That's what
Yeah, I bet he's great on the tools too.
the computer tool.
Yeah.
Google Sheets, obviously. Got a preference for that. Cool. All right.
Right on.
It was lovely to see everyone. And yeah, we'll touch base soon.
Thanks,
Leroy.
Leroy.
That was great. See you guys. Have a good day. See you.